This is the Rational Reminder Podcast, a weekly reality check on sensible investing and financial decision-making from two Canadians. We're hosted by me, Benjamin Felix, and Cameron Passmore, portfolio managers at PWL Capital.
Welcome to episode 217, and I noticed, Ben, we're both wearing black. Maybe that's because it's just after Labor Day. It looks black in the video, but maybe it's dark to signal it's the end of summer. Coming up. So I want to share a financial decision that we made here at home, James and I did, that led to greater happiness. We made a financial decision, and we got someone to help us do the housework. Absolute game changer. I've never had that service in my life. And, dusting and just the basic stuff, I just don't want to do anymore, and it started to stress me out not getting to it. So this woman came. She's fantastic. She loves what she does and did a phenomenal job. So kind of like, when you used to have your food service, freed up time and reduced stress. It's just, I had no idea that eliminating something that you dislike so much could bring so much relief and pleasure. It was great.
That's awesome.
Now I just need someone to do the gardening because I can't stand weeding, but that's a different story.
Yep. I just don't do that stuff. You should see my front yard. It's lots of weeds.
Well, the problem is I wasn't doing it either, right? Because I just didn't like doing it. So it's just nice to get it done. So
we joke that we have a weed garden. It's kind of crazy. Sometimes we just go down and chop down all these massive weeds and then they grow back. But yeah, we don't do a lot of lawn maintenance. We live in a forest though, so
yeah, so it's kind of the environment, right?
Yeah,
you can't really do that in suburbia and keep your neighbors happy with you.
Oh yeah, no, my house in suburbia wouldn't fit in for lots of reasons. Anyway, we're switching the format up a little bit based on someone was complaining about the intro being too long and they had to skip it or something. But anyway, that's not why we're making the change, but that prompted us to go and look at the YouTube retention data. YouTube has pretty rich analytics on what portions of the video people are watching and what portion they're skipping. And what we learned from that is that some topics, like the main topic that we have in every episode, has by far the highest retention. Other segments have lower retention. We've also had some feedback in the past that it's hard to share the episodes because if somebody wants to share the main topic, there's a lot before that to get through. And if somebody's not familiar with the podcast and maybe they don't want to hear us chatting with each other because they don't know us, and I get that when I listen to other podcasts, I totally understand. Anyway, so we're going to remove the reviews and the recent, move the reviews and recent contacts to the end of the show because I think it's still interesting and worthwhile to mention those things, but maybe not right at the beginning. Mm-hmm. We're also eliminating upcoming guests. The idea behind that initially was that it would give people a chance to review the research and stuff of the upcoming guest, but nobody's doing that. And if you are, I'm sorry, but I don't think anyone's really going and researching the guests before the episodes. Unless maybe there's a specific case where we think that it's important to have some pre-reading, but I mean, I don't know under what circumstances that would
I agree.
That would happen. So we'll lead with the main topic right after the introduction for the reason I said before, to make it easier to share, and it also reduces the amount of content that people need to skip if they don't want to hear the intro and all of the other preamble stuff. The other thing that we found in analytics is that on Apple Podcasts, which is where most of the audio downloads come from, people are not skipping. So there's kind of this weird disconnect between the YouTube data and the Apple Podcast data. But we're kind of taking the position that because it's easier to skip around on YouTube and people are probably sitting down at their computer, or at least they have their device available because they're watching, it's easier to skip. And so we're kind of inferring that on Apple Podcasts, even if people aren't skipping because it's more of a hassle because you're in the car, or you're going for a run or whatever, we're assuming that based on the YouTube data, those other segments are generally less interesting to listeners. So we're not eliminating them because the retention is not zero for a lot of those segments. We're just going to shift things around a little bit.
And it does make it easier. I do it on a number of other podcasts where you get to know how long the ads are. So as I said to you, the Tim Ferriss podcast is whatever, 10 advanced taps. So you just skip through the ads. So I think many people are doing that. So make it easier to get to the main part.
Yep.
Any updates on the crypto podcast?
Well, no, nothing big. I think our episode this week, when this episode comes out, is with John. Or John Carkin will be last week when this episode comes out.
That's right.
So that was a fantastic conversation this week. So tomorrow is Vili Letonverda, which was we had a lot of really good conversations in the crypto series, but these two are, it's probably recency bias, but they're some of my favorites.
Yeah.
So
sure.
Hopefully people enjoy those.
So speaking of other podcasts, I listened to one from Patrick O'Shaughnessy last week now, on his podcast, Invest Like the Best. He had David Senra on, who was an incredible high energy guest. So he's the host of the Founders podcast, and he studied hundreds of founders, people like Estee Lauder, Rockefeller, Phil Knight, Enzo Ferrari, and he studies their biographies and autobiographies. I think he's read like 1,000 of them, or some crazy number of books about founders. And Patrick argues he's probably the most knowledgeable person about founders on the planet. It was a really cool interview. So I reached out to him because he talked in the podcast about how he captures all this information about people and collates it to be able to add value in the podcast. It was a really interesting process. I reached out to him, and he's going to join us for our 22 and 22 reading challenge in a few weeks. I thought that was pretty cool. But I highly recommend, if you're interested in founders, go check out the interview with Patrick as well as his podcast. They're really, really good. Kind of last point I wanted to mention, it's funny how sales in the merch store slow down when we stop mentioning it. So I thought we'd mention the fact we do have the merch store. Stuff is available. It's good quality, super cheap. We don't take any spread on it. In fact, we give you a free pair of socks and a free beverage, cozy, in every order. So check it out in the Rational Miner website. Anything else, Ben, you wanted to mention?
It's worth mentioning there's a similar effect for the Rational Miner community, where if we don't mention it, the new signups slow down, and we have no incentive to grow the community. But I've said this before on the podcast. It's one of the nicest places on the internet to have real good discussions about financial decision making and portfolio management and all that kind of stuff, because it's got very high quality self-policing and very high quality moderation from a team of non-PWL related moderators. They're just people from the community that live all over the world that are in there. But it's a great place. So if people want to join those discussions, new applicants are always welcome. And there is an application process. It's not crazy, but you have to write a paragraph about why you want to join the community. It's reviewed by moderators, and that helps to keep the quality, the content quality high.
And there's how many people in there now?
It's getting up toward 8,000. I think it's about 7,600 now. So we figure by the end of the year, easily we'll be at over 8,000 users in there, which is kind of neat.
Agree. All right, let's go to episode 217. All right, welcome to episode 217. So since Ben's kicking it off, I did the intro.
All right, so our main topic today is the expected returns of financial literacy. And this, the reason that I wanted to cover this topic is that when a while ago we were looking at gender differences in financial literacy, there was an author, a paper author, an academic paper author, that had written just a tremendous amount on this topic. Her name is Anna Maria Lusardi. So I started reading her research, and she's like, in that field of financial literacy, she is either authored or co-authored. It seems like a majority of the papers on the topic. Like it's incredible. So I started reading her papers, and then I realized that there's a really interesting body of literature on this topic of why financial literacy is important, and empirically what the effects are of financial literacy on people's ability to make decisions. And of course, intuitively, you would expect some effect, but it's pretty interesting to see empirically what the effects are. But it's also interesting to see how financial literacy is measured, and again, empirically, how financially illiterate most of the world is. So I wanted to cover all of that, the empirical side, what impact does financial literacy have on decision making and financial outcomes, but then also how is financial literacy tested? And I figured we could go through the questions that are asked in a financial literacy test to make sure everybody that is listening would pass. It can be financially literate. And of course, this podcast is at a, I don't know, intermediate to advanced level. So you would think that many of the listeners are financially literate, but I think it's still worth going through the topic. So my argument is that financial literacy is probably one of the best investments that anybody can make. And that's, again, based on the evidence. And of course, like I just mentioned, if you're listening to this podcast, we're probably preaching to the choir about the importance of financial literacy. But when you look empirically, globally, about 2/3 of adults worldwide are financially illiterate. 2/3. In Canada, which is one of the most financially literate countries globally, still about 1/3 of the population is financially illiterate.
Unbelievable.
Yeah. And we'll talk about how that's tested in a bit. But in general, financial literacy is broadly defined as people's ability to process economic information and make informed decisions about financial planning, wealth accumulation, debt, and pensions. Now, the ability to process that type of information is economically important. Today, households are increasingly responsible for saving, investing, decumulating their wealth, whereas in the past, defined benefit pensions were more prevalent. Estimates derived from a stochastic life cycle model with endogenous financial knowledge accumulation. So that was a cool paper, by the way, which we can link in the show notes. But this paper estimates that from their model that about 30 to 40% of retirement wealth inequality may be accounted for by differences in financial knowledge.
Come on.
Yeah.
There's a showstopper right there.
Yeah, I know. Very interesting. Financial literacy has been shown to have significant predictive power for future financial outcomes, even after controlling for baseline outcomes and a wide set of demographic and individual characteristics that influence financial decision making. So two otherwise similar people, when you take financial literacy as the only difference, has big predictive power over financial outcomes. Pretty interesting. Based on that, of course, low levels of financial literacy are a big problem. People have to make important individual financial decisions all the time. And of course, that's important to living a good life. So the generally low levels of financial literacy are a pretty obvious problem, I think. People have to be able to make, you think about it daily, like every day, people are making decisions about saving, investing, borrowing, and spending. There's no way around that. That is how we exist. Everywhere. Unless you're maybe on like a kibbutz in Israel or something like that. But
so many of those decisions are related to people you're having relationships with too, which causes so much stress. Like it's just such a interwoven, complicated matrix.
Yeah, absolutely. Now, empirically, financially literate people are better at planning and saving for retirement, which makes sense, I guess. And they're more likely to participate in the stock market, which is another big one, among a bunch of other important financial behaviors, which we'll get to in a second. Another important note here is that financial literacy, when it's studied in the literature, is distinct from education more generally. So when you control for educational attainment in empirical models of stockholding, wealth accumulation, and high-cost borrowing, educational attainment does not reduce the statistical significance of the effects of financial literacy.
Wow.
So again, you take two people who are otherwise similar and both highly educated. If one has a higher financial literacy than the other, their financial outcomes are still going to be significantly better. And the significance of that doesn't change even if we are taking two educated people versus two less educated people. But it's interesting because more educated people do tend to have better financial outcomes, but the effects of financial literacy are still statistically significant on top of that. So financial knowledge seems to be a distinct form of human capital that contributes to financial outcomes beyond getting more advanced schooling. I thought that was pretty neat. Because, of course, you build human capital by getting education, increasing the value of your skills. But in excess of that, financial literacy creates a unique source of human capital.
Financial knowledge increases human capital.
Yeah, well, it absolutely does. Empirically, that is a fact. Now, the costs of financial ignorance are substantial, and there's some really interesting data here. So empirically, people with low financial literacy have lower financial wealth, even after controlling for other determinants of wealth like income, age, education, family composition, risk tolerance, patience, and attitudes towards saving. Financial knowledge increases the likelihood of investing in the stock market. So financial illiteracy decreases the likelihood of investing in the stock market, which of course allows people to benefit from the equity risk premium if they do invest in stocks. When people do participate in the stock market, less financially sophisticated households tend to exhibit stronger behavioral biases, hold a lower share of their portfolio in risky assets, hold under-diversified portfolios. They tend to tilt their portfolios toward volatile stocks with high share turnover and low institutional ownership, which are like the lottery stocks that we talk about sometimes. They also tend to have a greater bias toward home country stocks and the stock of their employers. Crazy. And I already mentioned that 30 to 40% of wealth inequality can be attributed, in a model at least, to financial knowledge. And the way that model arrives at that is based on expected net of fee returns. So people with lower financial literacy, because they're less likely to invest in stocks, they're going to have lower expected returns on average, which can explain a huge portion of wealth inequality. That estimate in the model is obtained by comparing wealth to income ratios across education groups in models with and without financial literacy, where financial literacy allows individuals to earn higher returns on their savings. Now, I mentioned net of fees. That's a very important qualifier here. Ken French had a 2008 paper, The Cost of Active Investing, where he basically details how much investors spend on active management. So he found in this paper, based on US data, that investors spend 0.67% of the aggregate value of the market each year, which is about $100 billion back in 2006, which is the data he was working with, searching for superior returns, which of course, as we know, most investors do not receive, and the average investor definitely doesn't receive.
Yep.
Now, on financial literacy, this is important because the least financially literate people are also the least likely to be sensitive to fees. They're more likely to bear the high costs of active management. It's crazy, right? Gus Sauter talked about this in a recent episode with him, that index investors have to be a little bit sophisticated because the arguments for active management are very casually appealing, but it takes a certain level of knowledge and sophistication to realize what the evidence says and that index funds make sense. So, I mean, just intuitively based on Gus's argument, I think that's interesting. The least financially savvy tend to incur high transaction costs, pay higher fees in general, and use high cost borrowing. In one study on credit cards, the least financially knowledgeable individuals in the sample made up 29% of the credit card holder population, but accounted for 42% of fees and charges related to late payment, exceeding their credit limit, using cash advances, and making minimum payments. People with less education and lower income, this is not a direct measurement of financial literacy, but those are both highly related to low financial literacy. So people with less education and lower income characteristics are characteristics strongly related to financial illiteracy, and those people have been found to be less likely to refinance their mortgages after interest rates decline. Now, this is also very interesting. So financial illiteracy and overconfidence go hand in hand. And I think this is one of the most dangerous observations in the financial literacy research, is that there is this mismatch, like in many other areas of knowledge. There's a mismatch between people's self-assessed financial knowledge and their actual knowledge. So even when financial literacy levels are low, respondents to tests on financial literacy are generally confident of their financial knowledge and tend to overestimate how much they know.
No surprise.
That's just normal, I think, in any study.
Yep.
Individuals who are overconfident about their financial literacy were found in one study to be more likely to believe that abnormally higher returns, a classic attribute of scams, are attainable in investments. Overconfident people have been found to be more susceptible to financial bullshit. And I'm sorry, Cameron, but that is an academic term. It is. There's a published paper with that title.
You're just accurately reporting.
That's exactly it. And maybe not surprisingly, overconfidence in one's financial knowledge is associated with fraud victimization. People with low financial literacy are also less likely to detect fraud. Now, interestingly, people with low measured financial literacy who self-assess their financial literacy as high, so overconfident people with low financial literacy, were found in a U.S. sample to be much more likely to own cryptocurrencies. Another study spanning 15 countries found that the financially illiterate are much more likely to own cryptocurrencies. And a study of Canadians found that Bitcoin ownership from 2016 through 2020 was concentrated among young, educated men with high household income and low financial literacy. And those attributes together are shared by investors who are overconfident in general and are susceptible to financial bullshit.
Absolutely fascinating.
Yeah. Men are generally more overconfident than women. That's been found in many other studies in other disciplines. Possibly related to this overconfidence, men are also more likely to overtrade in their brokerage accounts, which is something we've talked about in the past.
Yeah.
Overconfident investors who believe that the precision of their knowledge about the value of a security is greater than it actually is trade more than rational investors would, and doing so negatively affects their outcomes. Women are typically found to be less financially literate than men globally, but about 1/3 of that gap seems to likely be explained by a lack of confidence rather than a lack of knowledge, which is kind of interesting. Now, investing aside, financially literate people are more likely to engage in retirement planning. And empirically, those who engage in planning accumulate more retirement wealth. So that may also be related to that financial literacy related wealth gap. So it's related to expected returns, but also to the just planning, which results in saving. People with low financial literacy tend to have low financial well-being, which is measured on a scale based on control over day-to-day finances, financial freedom to make choices to enjoy life, capacity to absorb a financial shock, and being on track to meet financial goals. Just that point alone is huge. Studies that identify specific components of financial literacy tend to find that advanced financial knowledge, like an understanding of risk diversification and the capacity to do calculations, are most impactful to financial outcomes.
Boy, okay. Sure poured it on there.
Yeah, so all that just shows the multitude of reasons for why financial literacy is important in the data. When you look at people who are financially illiterate, the decisions that they're making or not making are very meaningful to their economic outcomes. Now, how is this measured? So we talked about a lot of attributes of people who are financially illiterate. How do we know they're financially illiterate in the research? The instrument used to gauge financial literacy in a lot of studies that I reviewed is a short set of 3 or 5 questions. It's called the Big 3 and the Big 5. And then they cover 4 topics. The 5 questions cover 4 topics: risk diversification, inflation, numeracy, which is just like the ability to do calculations, and compound interest. Yep. There was a massive study, the S&P Global FinLit Survey, which covered more than 150,000 people in more than 140 countries. And people are considered financially literate in this study if they demonstrate knowledge in 3 of those 4 topics that I just mentioned. So for the rest of this topic, what I want to do is go through and make sure that listeners can answer the questions and talk a bit about why it's important to be able to answer them. And if listeners, because again, this is not a podcast for beginners, so if people listening find these questions easy and obvious, then I hope it gives you an appreciation for the generally low levels of financial literacy in the population.
So these are the actual questions from that survey.
Yep. So the first question is, suppose you have some money. Is it safer to put your money into one business or investment, or to put your money into multiple businesses or investments? So of course, Diversification is often referred to as the only free lunch in investing. When you add more imperfectly correlated assets to a portfolio, you decrease portfolio risk, measured by volatility at least, without reducing expected returns. Typically in investing, decreasing risk also means decreasing expected returns, but diversification is the exception, which is why it gets to be called a free lunch. In general in investing, there are two types of risk: compensated risk, where you do earn an expected return for taking the risk, and uncompensated risk, which is really just a random risk that is not associated with a positive expected return. When you diversify across lots of stocks, you dramatically reduce uncompensated risk, I think arguably even down to zero when you own like a total market index fund. And you don't want that kind of risk, so that's a good thing. But with diversification, you maintain your exposure to compensated risks, which is what you do want.
Yeah.
So that's why that one is important, but it's important to understand that a lot of people don't know the answer to that question. The next one covers inflation. So the question is, suppose over the next 10 years, the prices of the things you buy double. If your income also doubles, will you be able to buy less than you can buy today, the same that you can buy today, or more than you can buy today? So of course, in this case, with inflation and income changing at the same rate, you can buy the same amount that you can buy today. Relative to your income, which has also doubled, the cost of goods has not changed. Understanding inflation is super important because decreasing purchasing power of cash over time can be significantly financially damaging. There's often this perception that investing is risky, but I think that not investing, and this is shown by the empirical data on financial outcomes sorted by financial literacy, not investing can be even riskier than not investing when inflation is considered. Now, that can be a somewhat controversial statement because over any time period, stocks are going to be more volatile. I just saw a brand new paper that is actually written by an upcoming Rational Reminder guest. They looked at stock, bond, and bill returns going back to 1890, I believe, maybe a bit earlier. And using that historical data for 38 countries, they created bootstrap simulations and found, I'm not going to remember the exact numbers, but the probability of losing to inflation over 30 years was materially lower for stocks than it was for bonds, and even much more so for bills. So I think it just speaks to that risk of not achieving your financial goals or risk of not accumulating wealth over the long term is arguably greater for what we would generally consider less risky assets when inflation is considered. Anyway, yes. So that's why understanding how inflation works is very important. And I guess I just related it back to thinking about different types of risk. The next one is numeracy. So the question is, suppose you need to borrow $100, which is the lower amount to pay back, $105 or $100 plus 3%? That seems pretty basic. But again, empirically, a lot of people can't answer that question. So of course the answer is $100 plus 3%, since 3% of $100 is $3. Not being able to do those types of calculations, maybe that's why we see higher instances of high cost borrowing, for example, with people with lower financial literacy. The last two questions are on compound interest. Now, the creators of this survey determined that this is one of the hardest topics. So they give two questions, and you only have to answer one of the questions correctly to get the point for the compound interest topic. Suppose you put your money in the bank for 2 years, and the bank agrees to add 15% per year to your account. Will the bank add more money to your account the second year than it did the first year, or will it add the same amount of money in both years? So of course the bank will add more money in the second year, since they'll be paying interest on your initial investment and on the interest that you earned in the first year. And that topic of compounding, again, for long-term decision making, is absolutely critical. Because the sooner you start compounding, the better. Not understanding that, you can see why somebody who does not understand how compounding works would have less motivation to plan and save for retirement. The second one on this topic is, suppose you had $100 in a savings account and the bank adds 10% per year to the account. How much money would you have in the account after 5 years if you did not remove any money from the account? The answer options are more than $150, exactly $150, less than $150. The answer, of course, is more than $150 since 10% of $100 is $10. And we know that we'll get more than the simple interest of $50 in total due to the compounding effect. So I mean, compounding is the magic of investing. That's what gives us exponential rather than linear growth over time, but it requires starting early and sticking to a long-term plan. And of course, if you have debt, compounding works in the other direction. So I mentioned why people with low financial literacy may use high cost debt more frequently. Maybe this is another reason if you don't understand compounding.
Really makes you sympathetic though, right? That these questions can cause that many problems for so many people.
Yeah.
Like it's a real issue.
It's a real issue. In Canada, a third of people in Canada fail this test.
Fail is deemed to be if you miss how many of the questions?
I said it earlier. People are considered financially literate if they demonstrate knowledge in 3 of the 4 topics.
Okay. Fascinating.
Yeah. So I'll just briefly touch on the distribution of financial literacy globally. Countries with the highest financial literacy rates are Australia, Canada, Denmark, Finland, Germany, Israel, the Netherlands, Norway, Sweden, and the United Kingdom, where about 65% or more of the adults are financially literate. South Asia is home to countries with some of the lowest financial literacy scores, where only a quarter or fewer of adults are financially literate. In advanced economies like the G7 countries, 55% of adults are financially literate on average, with Italy and Japan having the lowest literacy levels. In major emerging countries, 28% of adults are financially literate. Across the literacy topics, I think I mentioned this already earlier, risk diversification. Oh, I didn't mention this. Risk diversification is the most poorly understood. Just think about that. That's the most poorly understood topic out of all of these. Risk diversification.
Explains so much.
And again, makes you sympathetic to why many people hold individual stocks or pick stocks or whatever. Okay, so improving this is a huge task. And it's a really interesting policy question. A lot of this literature, which you would expect, I guess, based on the topic, does discuss policy, but it's not obvious how to approach the problem because there is a theoretically optimal level of financial literacy knowledge for each individual. Financial literacy above that level is actually not a good investment. So if policymakers are forcing financial literacy education down people's throats, that comes at a cost to the person who is being forced to consume that information. It comes from at a cost to the government or other institution that is delivering that education. But the optimal level of financial literacy varies from person to person and household to household. So as an example, someone with a full pension and low non-pension wealth has much lower financial literacy needs than someone with no pension and high financial wealth. Or another way to think about that is countries with a larger social safety net, the financial literacy needs are lower than countries with no social safety net. So it's not an obvious thing to let's put financial literacy education in schools. Maybe that is a good thing to a point, but there's also a point where it becomes excessive and starts pushing a cost onto people for having to consume that information.
And how much of it's one's own responsibility? How much is it the responsibility of the financial industry to act like fiduciaries and look out for someone's best interest, even though they may have low financial knowledge? It's a really complicated problem.
It is a complicated problem, which is probably why we haven't seen big sweeping solutions that solve it. So my hope with this topic was to give people an appreciation of the situation for financial literacy, help people see what topics people struggle with, and we tried to give some color as to why those are very important for making financial decisions. I don't expect to solve financial literacy. We just talked about how messy of a problem it is. But I kind of figured that if we provide that information, that our listeners, who are probably already financially literate, but if our listeners understand the scale of the problem and the scope of the problem, maybe everybody, and now that we understand what those main topics that are important for financial literacy are, if everybody takes that away and makes sure someone in their life is able to answer those financial literacy questions, and maybe we can link, or we will link the S&P FinLit survey because the questions are in there. So I figure if everybody takes from this episode as a takeaway, takes this information and goes to their, I don't know if it's a spouse or a parent or a sibling or whatever, or somebody else that's close to them, and make sure that they can answer the questions and understand why each of the topics is important, then maybe we can move the needle a little bit, just a hair in the right direction.
Great topic. Absolutely fascinating.
I think it's pretty cool.
All right. You want to talk about this article, FAANGs Gone Value?
Yeah. So we covered this a while ago because it was in the Financial Times, I think. There was an article about Facebook becoming a value stock based on the Russell Index reconstitution, which is just kind of neat to see. Dimensional recently did an article on their blog about this called FAANGs Gone Value. So FAANGs, of course, are Facebook, Meta, Apple, Amazon, Netflix, and Google, or Alphabet, as they've called themselves. So we hear this argument against value investing, which is that there's a new normal where innovation and technology have changed the investment world. And then the old guard companies like energy and banks are not where returns are going to come from in the future. And we've been hammering on this for, what, 3 years we've been talking about the same topic, that the biggest companies don't stay big forever. And once a company becomes the largest company, it doesn't tend to have good returns. And this time is different every time. And we've made all these same arguments. And we got interesting pushback in the past, and we've talked about this, especially when the prices for the FAANG stocks were just going through the roof.
Yep.
And we were like, this time's not different. And some people were like, no, it is different because of this, and this. The companies are different. The network effects are different. The scale is different, whatever. Anyway, so this article from Dimensional highlights that 2 of the FAANG stocks, both Meta and Netflix, are now considered value stocks based on they were switched from growth to value in the Russell reconstitution.
And that reconstitution happens, I think it's every June each year, right?
I think so, yeah.
But yeah, they reshuffle it based on the new economic information of the companies.
Yeah. So it's just kind of funny. And in that article, the author shows that 2/5 of the stocks that were often used as illustration for the dominance of growth are now in the value camp. And then they also had some very interesting data on the performance, and we've spoken to similar data in the past, but it's still super interesting to see this one. So they show the performance of stocks, of the largest stocks in the U.S. After a company has become one of the largest 10 stocks in the U.S., they show its performance leading up to that point and its performance afterwards. So in the 10 years before becoming one of the largest stocks in the U.S. market, companies on average return 10% per year for the 10 years prior. 5 years before, they returned 19.3% per year on average. And 3 years before, they returned 24.3% per year on average. So you could see, yes, if you could pick the largest companies before they become the largest companies, you would have excellent investment returns.
That's how they became large.
That's why they became large. But that also means, they may have peaked. Maybe their valuations are high. I don't know. There's probably lots of effects like that. So then after joining those 10 largest companies, for the 3 years after on average, this is so crazy. The 3 years after becoming one of the largest 10 companies in the U.S. market, companies return 0.7% per year on average. For the 5 years after, they return negative 1.1% per year on average. And for the 10 years after becoming one of the largest 10 companies in the U.S. market, they return negative 1.5% per year on average. So yes, if you can predict which companies are going to become the largest companies before it happens, you'll make a killing. 24.3% per year for the 3 years before. But after, once they've become the largest company, that doesn't tell you much about expected returns, at least not in a good way.
But anecdotally, this is what we've lived since the late 90s. And I know we've given this example so many times, but there's so many stocks that were the ones you had to own back in 98, 99, 2000 that aren't back to today what they were worth then. Like, you've had dead money, in some cases, not even dead money, for the past 22 years.
Yep.
And these companies, many of them have grown, profits have grown, doesn't matter. These are great companies. Is what you pay for them is what matters.
Yeah, it can take 20 or 30 years, like you're saying, for a company to grow into its valuation.
Yeah. So interesting.
Yep.
All right, on to our book review.
Let's do it.
As my investigation into this whole deep work, working remote continues, I revisited a book that I started a couple of years ago called Reclaiming Conversation, The Power of Talk in a Digital Age by Sherry Turkle. And, after last week's discussion, or 2 weeks ago, I guess now, I decided to go back and revisit this book because it talks about the power of and the need for face-to-face communication and contact in our world, because that was one of the outstanding questions that we had. So, first, about the author, Sherry Turkle. She is a professor of social studies and of science and technology at MIT, and is the founding director of the MIT Initiative on Technology and Self. And to paraphrase what that is, they study the relationship between technology and conversation in a digital age, psychology of online life, how we share and withhold information, and the impact of online conversations on innovation and leadership, which is kind of exactly what we've been talking about, going back to Fearless Organization, Deep Work, even going back to Johan Hariri's book a few months ago, and right through Running Remote. So this is kind of right in the sweet spot about how people need to interact in that world. Now, this was written in 2015, long before the pandemic, long before working remote. So I may be drawing inferences from the book that she may disagree with, but these are my interpretations from the book. So she is also a clinical psychologist, and she has a joint doctorate in sociology and personality psychology from Harvard. So as I mentioned, the outstanding questions that I think we had after the Running Remote discussion were, if you do go remote, is there a human side that's missing from working remote? Do we need face-to-face interactions? If we do, how do you do it? How do you do that without avoiding all those things that were not good in a synchronous environment, like interruptions, wasted meetings, gossip, drama? So this discussion is not so much a book review, but more insights I drew from the book that can help us in this thinking. And this applies to everyone, right? Whether you're an employer, team leader, employee, I think it does have an impact on decisions you will make, which do impact you financially. So the point of this book, pretty straightforward. Technology is killing conversation. Reclaiming conversation is a step toward reclaiming our most fundamental human values. So I quote here, "Face-to-face conversation is the most human and humanizing thing we do. Fully present to one another, we learn to listen. We learn empathy. Conversation advances self-reflection as we learn from others. Eye contact is the most powerful path to human connection." And the point of the book, obviously, is that technology is causing all sorts of problems. It's reducing the quality and quantity of conversations that people are having. And again, this is long before the pandemic. When people meet, the quality of the conversation is reduced when we divide our attention between the people we're with and our phones. And so there's a proof point on this. So studies show that there's just the mere presence, get this, the mere presence of a phone on the table, even if the phone's turned off, changes what people talk about. If we think we might be interrupted, we keep conversations light on topics of little controversy or little consequence. And conversations with phones on the landscape block empathic connection. If two people are speaking and there's a phone on a nearby desk, each feels less connected to the other than when there is no phone present. Even a silent phone disconnects us. If that doesn't blow your mind, just put it on the table. Even many of us put it face down. It's kind of this beacon towards keep it light. I might be interrupted. This little signal matters to me. So the question I have from that is how is this now with people in online meetings who are obviously doing other tasks during the meeting? And we see it. I think we all see it who work in an online world. It's easy to kind of click on email or Teams when you're in that meeting. So does just having that Teams or Slack or whatever open while you're in an online meeting have the same effect? I don't know. It's a question I have. Another problem that technology causes, it gives us the illusion of companionship without the demands of friendship. And this is leading to people being less empathetic. So another proof point, from 1995 to 2015, so up to when the book was published, there was a 40% decline in the markers for empathy among college students, with most of the change in the last 10 years lining up to the time when portable technology really advanced. It's a trend that researchers link to the new presence of digital communications. So another problem here, we have a generation that is not learning that boredom is good. Many people don't allow themselves to be bored. They're never alone, even though they may be with their phone. They're rarely ever in solitude. That seems pretty obvious, right? But you think about like the generation, certainly the generation after me, but even the generation behind you. Like there's never need to be bored. There's always something you can scroll through, and the companies are so good at feeding you what interests you that if you have nothing to do, well, you just scroll through something, be it Facebook, TikTok, and it's so good at engaging you, but you're never in solitude. And the problem is that you need boredom, because boredom, this is what the author argues, boredom spurs imagination. And more generally, the experience of boredom is directly linked to creativity and innovation. Solitude reinforces a secure sense of self and the capacity for empathy. Then it enables you to provide others with rich material for their self-reflection, going back to the fearless organization. If you are going to do deep work, you have to be confident in the work that you're doing and then be able to bring it back to others to help them in their drive to solve problems. So if you don't have practice in thinking alone, you're less able to bring your ideas to others with confidence. So I think this is not terribly new to a lot of people, but I had a underappreciation for how important it is to be able to be in solitude, just in being bored. So many people just are not bored. And I remember, I think when I was growing up, the games we used to create, because we never obviously didn't have technology growing up like this, and I just think that whole experience is gone for so many people, right? So to link this to a discussion regarding running remote, deep work, and the fearless organization, I think it's important to both the employee and the company that people be able to do deep work. I mean, that's a given, I think. This is both a personal skill that we've talked about, but it's also important in their environment that they could do deep work. Many in-office environments just hamper that with distractions from colleagues, and that causes the individual to lose control of their own environment. But people are not the only distractions in the current work environment. Even if you work remote, tools like Teams and Slack are often arguably even more disruptive than colleagues in an office. There's so many things coming at us every day, be it people in the office, be it our desktop technology these days, or our attached cell phones, that's coming at us is very disruptive. So you combine the work tool demands, the allure of Twitter, Facebook, Snapchat, TikTok, whatever, it makes for a pretty tough opponent for your attention. And much like I said, reviewing the book Running Remote, this is regardless of where you work. The whole synchronous, asynchronous model, that again to me is regardless of where you work. So still have the same question, right? Do we need open-ended, spontaneous, synchronous conversations? The author is pretty emphatic, saying, yes, we do. Conversations in which we play with ideas, allow ourselves to be fully present and vulnerable. These are conversations in which the creative collaborations of education and business thrive, the author says. So, key takeaway for me is for the time with others to be more productive, you need time with yourself to be more productive. You need to learn how to turn off the distractions, work in solitude, and then we need to learn how to engage in a more productive solitude. Then with this productive solitude, you're better able to be intentional with your colleagues when face-to-face, more deliberate, more thoughtful, if that is the objective. And this goes right back to running remote, where they talked about, have clear processes documented and have clear communication processes, and go back to fearless organizations, that when you come back to the team with a problem that you've been working on in your deep work, you can add more value to that discussion.
I remember from talking with Liam, the author of Running Remote, about this. He's not opposed to face-to-face meetings. And you may know this from the book. I don't know if it's in there. But in their company, they will occasionally travel to meet together in person, but it's never with everybody, because that can't be productive. It's like if there are 2 or 3 people required to solve a specific problem, then it can make sense to meet face-to-face in order to solve the problem together, for a lot of the reasons that you're saying, to create ideas and spur creativity and all that kind of stuff. But it's also, like you're saying, it is for a very specific purpose at a very specific time, when everybody is coming with knowledge that they've developed in their own in their own deep work, as opposed to meetings with lots of people where everybody's going there to try and do what should be done as solo deep work.
And it's to be more thoughtful about those meetings, I think. Like, what is the objective? So I'll skip down to one of the punchlines. So this has led me to start reading a book that actually Tessa, your sister, who's our lead of culture and HR, she said I should be reading the book, The Art of Gathering by Priya Parker. So I'm reading that book now. And although it's a lot about social events and event planning, a lot of it does lead to a work environment where she puts forth the argument that every meeting should have an objective. And if you have a recurring meeting, what is the objective of that meeting? If it is just to update people, say objective is to update people. That's a very specific objective. The problem with a lot of meetings, including recurring ones, is everybody might have a different opinion of what they want to get out of the meeting, right? I might just want updates. You might want to know what action items you can add value to. If we go at the same meeting with those objectives, neither of us are going to be happy, or probably one of us will be really unhappy with the meeting. So it just means, again, this is what Liam talked about, put more thought into stuff ahead of time before you pull people together, before you put the email to them.
I think a common reaction when something needs to be solved is to book a meeting to solve it. And I think that's
absolutely. But that's the default in a synchronous world. That's the world I've always worked in. Many of us have always worked in.
Let's brainstorm. Let's get together and brainstorm. But that's like one of the worst ways to come up with.
And you have a generation coming up behind us that doesn't have the ability. I don't want to overgeneralize, but she puts forth the argument that many people don't know how to be alone just to think, because the stuff is always coming at you. And that, I don't see that as a remote issue. That's just an issue. So the issues I'm learning are actually bigger than this whole remote debate. How much time is being burnt by people on the phone? I don't know the answer. It's got to be huge.
Well, you can know, right? Because does your phone tell you what your screen time is per every week?
Sure, it does.
What is it?
I don't check it. I suspect it's not good. I'm not in any sort of denial.
Doesn't it give you a notification to say what your screen time was for the previous week?
I probably turned that off. I don't get that.
Oh, interesting. I think I get it every Saturday or Sunday or something. So I had an iPhone X, I think, which is like old now, but it was new when I got it. I had it for 2 years maybe, and I dropped it one day. The screen didn't break, but the chip inside, I guess, died, and it was going to be very expensive to replace it. And my screen time was higher than I would like to admit when I had the iPhone X, because I had like Teams and email and the Rash Reminder community and text, like everything was on there, and so it was easy to do stuff. And when that phone broke, I decided that rather than buying a new fancy iPhone for $1,600 or whatever they cost, I revived my iPhone 6.
You went backwards.
Now the thing about my iPhone 6 is that it can no longer run most of those apps. Like the Rash Reminder community does not load. I have the app on there, but if I click on it, it just doesn't load. Great. All of our work related stuff, I can't have on there because we have some security app that PWL requires employees to have on their phone in order to download or in order to access our servers. I can't access that security app because my phone is too old. So all the stuff that I used to burn time on my phone is no longer, I can't use it.
Yeah.
And my screen time has dropped. It's like under an hour. It's probably like, I think it's like 40 minutes on average each day, which is substantially lower than it was previously. And now I'm hesitant to go and get a new phone at all. And this is a thing. People have, I can't remember what it's called. I want to say narrow phones, but that's not it. That's narrow banks. It's something like that where the phone only does like texts and calls, nothing else. So I mean, there are solutions to this problem of phones just sucking your attention away.
Yeah, I don't like. I do a fair amount of Twitter, but maybe this is just me making up stories. I view it as a lot of research. I cut out a lot of the news that I used to follow because it was just such a waste of time.
Oh yeah, Reddit. I still have Reddit. That's a.
Yeah. Oh, I don't dare. I don't go to Reddit. I would be in there for a long time. I don't have TikTok. Very few people on Instagram, so I think I'm not bad, all things considered.
But it's a reaction. Like I notice personally that if I'm struggling with a hard problem, there's a reaction to pick up the phone and make the pain go away.
Really?
Rather than sitting down and focusing on solving the thing. I don't do that with my broken phone because there's nothing on there. Or likewise, if there's like a stressful situation, it's so easy to pick the phone up and scroll through. It's honestly like a drug or whatever. Like it makes pain go away.
It does.
Yeah.
And it makes you feel like you're being productive. That's another point that she makes. Because we're so hyper productive, like we can answer Teams. Like you can be on a call answering Teams, responding to emails. People know, they can see your eyes moving around. You can answer text, you can do all kinds of things while you're doing other things and you think you're productive, but you're not really being present. Conversation not as deep. And that's missing.
I'll tell you the other trick I have with my old iPhone 6 is that it has my wife's purple case with gold glitter. And so I'm also too embarrassed to pull it out if I'm in a face-to-face social interaction. So those are my two hacks.
Okay, so that'll work then. So you're not bringing that at the dinner party or something.
Yeah. Well,
that's one way to do it, but it's given me more awareness of what other challenges people have. And again, I don't think there's an absolute here. Everybody is different, so there's going to be some sort of mixed model, I think, that companies will have to figure out. Will offices go away? No, but I think the way we worked, I think progressive companies will work on that much more. Do more asynchronous, figure out the distractions, and then after that, I think that's the elephant, not the in-office or home. I don't think that's as big a...
The distractions are huge. Who else did we talk about this with? With Ashley Willens, I think, when she calls it, she's referencing a different researcher. I don't remember who that is, but they call it time confetti.
Yeah. Where
you get pulled in all these different distractions, and so you don't have any big blocks of time for anything, not for leisure, not for work, not for anything. And it's a disaster. I think this is, I'll make a prediction here. I think this is going to be the kind of thing that we look back on in, and I'm not the first person to say this, but I think it's the kind of thing we'll look back on in 20 years or whatever, and it'll be like smoking or something like that, where now we look back on cigarettes and we look at ads for how they could calm you down or whatever, endorsed by doctors, and we think about how crazy that was.
But we did talk about this. Like the social media companies have an opportunity to make things better. Instead of making it so addictive. Like Tristan Harris, who was from Google, I was reading about him in the book test I recommended this morning. Talked about how, there's one of you on this side of the phone, but he said there's thousands of engineers on the other side of the phone that are there just kind of draw you in. Well, they could do things to help you with tools to improve your life, be it fitness, be it relationships, be it whatever. There's things they could do, but it's an ad-based model. They want to keep your eyes on there.
Yeah. I think it is affecting people a lot. And I know, like, I don't even want to say what my previous average weekly screen time was, but it was high. And I knew, like, I would think about trying to spend less time on my phone, but it's hard. It's easy now because there's nothing on there.
So if anyone out there has book suggestions on the topic of meeting face-to-face, this book by, like I mentioned, The Art of Gathering is okay, but it's not really as workplace related as I had hoped. Still a lot of good stuff in there. But if you have something, send me a note. I'd love to hear about it. So there you go. You want to take a look at some reviews?
Yep. So we had two new reviews. We always appreciate them. One from Matty Boy 99 from Great Britain. They say that this is the best podcast for aspiring financial advisors. They're a long-term listener, only writing a review now. They've listened to pretty much every podcast episode and watched all of my YouTube videos. They love the open-minded, evidence-based approach to investing, financial planning, and well-being. And it's inspired them to start their own channel and website about personal finance. That's always cool to see. And to pursue a career as a financial advisor. That's cool.
It's interesting. This is actually Martin, and he reached out to me on LinkedIn. And I mentioned him that I may be in London in November, so he's going to try to organize a meetup. So again, drop me a note if you're in London and you might be interested in a meetup if I end up going to London in November.
Oh, that's cool. That'd be super cool to have a London meetup. I won't be there.
Well,
I don't ever want to get on an airplane again. You think that's overly ambitious? What do you think? Think I can do it?
It might be a little assertive, but yeah, I'm also going to as you know, the Future Proof Conference in September. Well, coming up very soon in Huntington Beach. So I'm sure I'll be meeting up a lot of people there that are listening.
Yeah, I won't be there either. G Campagna from Canada says, excellent podcast. I'm learning a lot every week, and that's coming from someone who already was doing investing in a way that's similar to a lot of the conclusions that the podcast comes to. They appreciate the crypto series as it approaches the subject in a way that they've never seen before. They do say that the podcast is heavier than the average podcast, and that they need to listen to it doing an activity that won't be interrupted a lot, because you really need to you need to be in the flow to follow the discussion. So that's interesting. And they do ask that we include chapter markers in the podcast. That is something that we're working on. I didn't even know about this, but the same person that gave feedback that started a thread in the Rational Minder community that we talked about at the beginning of the episode, which led us to investigate the data and switch up the format a bit. In that thread, we also learned about different ways to do chapter markers on different platforms. So on Spotify, there's a different format than on Apple or whatever. So we're working with our production team to get the proper chapter markers on all the different platforms. And the other thing that's really cool that somebody suggested is that in the audio versions of the podcast, if we have a chart, we can use a chapter marker to line up with the chart, and you can have artwork for each chapter. So if we want to show a chart on Apple Podcasts, for example, we can have artwork that goes with that chapter marker. So people following along on audio can, if they want, pull their phone out and view the chart we're talking about. So that's something I didn't even know. It's kind of cool. So we will be making those tweaks as well.
Cool. Also heard from Pete Zaw from the U.S. Very smart host with insightful guests. Ben and Cameron, both very smart people. Always feels weird giving these reviews. Feels so self-indulging. Although I must admit, I don't feel as bad about that since it's at the end of the podcast. Because if people are interested, they would have bailed by now anyway. So I guess they're here if they want to keep listening to it. Anyways, to say we do a great job explaining financial concepts for even those who do not have a traditional finance background, such as myself. Every guest they have on the show has some really interesting and thoughtful takes. And I really agree with that. I think the guests are and have been phenomenal. Also had some really interesting connections last week that I think are worth highlighting. I heard from Chris, he reached out to me. We had a conversation this week. He's a fee-only financial planner in Alberta who's considering starting a podcast. So kind of like what Rob Mingan's doing and others, having the fee-only model. I think there is great demand for that. I also heard and spoke to an advisor this week in Ontario who is with a bank and who wants to migrate to the independent advisory space. And I've never worked in a banking environment, but talking to him and others, of course, it's just such a different animal from the independent space. So that was a really interesting conversation. So shout out and thanks for reaching out. Also spoke with an advisor in Coquitlam. And this is an interesting question for us to think about. So he was asking about the podcast and whether we found that all the to-dos that go with the podcast are draining our happiness. And I said, interesting questions. I'll let you answer as well. But I thought it was an interesting question because if you don't love the process of doing a podcast, there's no way you'll keep it up. I think there's just too much work and there's too many to-dos. But, having a purpose, we talked about this over the past month or so, does give happiness. And I think we do have a purpose. And I personally just love the whole experience, even though there are a number of to-dos for sure. But so much of the research is part of, and I know you always say this is part of what your day job should be anyways. So you should be doing the research. You should be reading some level of books. So I don't find it a drain on happiness at all. What do you think?
I agree with what you just said. It's part of my regular job, but my regular job, I don't even feel like is a should. Like there's not a whole lot of stuff that in my job that is something like, oh, I've got to do that.
But you know what's funny about this? I think about your answer. So we're preparing to give a presentation to advisors that are coming to Canada about the podcast. And I think a lot of people, and I talked to someone else yesterday about this, who thought, well, you must have an editorial calendar all planned out like a year in advance, and you think about your key messages and your value proposition, and you plan all the guests out. And I remember in our preparation meeting for that presentation, you're like, yeah, I don't have a whole lot to say. And it's true. There's a whole lot of chaos that happens behind the scenes. We do not have an editorial calendar. We do not plan out more than 2, 3, 4 weeks in advance.
If that.
Just in terms of guests, not topics. I mean, I never know what your topic's going to be week to week. You don't know my book review week to week. The thinking is going on, but the point is, like, I would find that tedious. If we had to meet and have editorial meetings and stuff like that, that would start to become tedious to me.
Oh yeah, 100%. But that conversation was funny because based on the questions that were being asked to answer for that presentation to other advisors that you're talking about, it became apparent to me that they were looking for the sort of the secret sauce. Like how they want to know what is the process that you follow so that we can do something similar. And I'm like, there's no process. I think my answer was like, I work in air quotes ridiculous hours on this stuff, but it's not because I'm miserable and I'm grinding it out to achieve something. It's like and it speaks to the question that we're answering from the advisor in Coquitlam. I thoroughly enjoy it. Like the crypto series, I don't know how many hundreds of hours. I think that's
sure.
I don't even. Yeah, I've put into it at this point. But it's thoroughly enjoyable. And if like you said, Cameron, if it's not, if someone's trying to do content and it's not thoroughly enjoyable, it's probably not going to work because it is a ton of time, but it's not time that I have to like force myself to spend doing this stuff. I mean, it's like,
and to that point, I don't think you can force a lot of it. I mean, the example of David Senra coming on the podcast I mentioned at the top, that came from just randomly listening to one of Patrick, Invest Like the Best interviews. Thought it was great. You had to figure out, we call it slinking, had to figure out how to get to him because it's not obvious how to find him. So ended up digitally chatting, and he agreed to come on. Like that to me is super fun, but if you're not kind of immersed in it, there's not like some recipe book. Okay, you go down, there's the guest, tick, tick, you do this. That's not how it works. Look at you found guests this week coming up this fall. Just random poking around and thinking, and you never know where the opportunity is going to be. And if I wasn't on Twitter or podcast and kind of immersed in this, we wouldn't find the ideas, I don't think. But
no.
Whether that works for everyone, someone's got to find their own recipe for what they want to do.
Yep. But the immersion is necessary. And the immersion, if it's not, and if it's a task, if it's a to-do, the immersion would make you go insane.
Well, can you imagine if you didn't like doing research and someone said you had to work X dozens of hours per week to do this? Like you couldn't.
Yeah. Yeah, I know. Well, the last 2 weeks, I spent a ton of time, and this is only tangentially podcast related. It's my regular job related, but I spent a ton of time developing expected return assumptions for alternative asset classes. And it was like, I don't know, over the last couple of weeks, probably 15 hours of work. But I loved it. And it'll be an internal white paper at least, but I don't know if we'll publish it externally. Maybe we'll talk about it as a podcast episode. Ray, my senior researcher on the research team, he suggested that. He was like, this is good. This is really cool stuff. You should talk about it on the podcast. So maybe we'll do that. But the point is that was like fun. I had to remind myself to take breaks to eat because I was having such a good time. So that's, anyway, there are no to-dos. The to-dos are the other stuff in life, like, exercising and making sure I eat because the work is enjoyable.
I think that's the key message. And that's what I told Robert yesterday, who I met, an advisor in the U.S. I said, you got to find something you love. You got a topic you love, run with that. Yep.
Anyway, we're droning on here about this, but it's kind of freeing having this at the end of the episode. There's no rush.
There might be 3 people left. Everyone's bailed.
That's fine. I real quick on conversations related to the podcast. I had a conversation with somebody this week who is very accomplished in their professional career, and they're looking to make a change in their career. And they said that they wanted to talk to me because they want to do something impactful, and they listen to our podcast, and they believe that what we are doing is extremely impactful to a lot of people, and they've got a lot of respect for what they're doing. So anyway, they wanted to talk about next steps for themselves, but I thought that their words about what we're doing with the podcast were very kind, and it was just kind of a cool interaction.
I agree. All right. Anything else?
Nope, that's it.
All right. Thanks to the 3 people who are still here listening.